Cannabis stocks have been killing it with Biden's win. Instead of investing blindly, you should really understand the company's fundamentals and financials. Let's look into Canopy Growth a little deeper to figure out if the stock is a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day to 8 a.m. In this video, I am going to walk you through the process of valuing Canopy Growth stock by analyzing its financial ratios and dissecting its financial statements so we can determine if it's a buy or a sell. Canopy Growth is a Canadian cannabis producer. Through its subsidiary Canopy River, it helps fund and provide strategic support to other cannabis businesses. Let's get started with the model. This is a mid-cap company, market cap $9.1 billion. They're trading at $24.52 a share, and they have 371 million shares outstanding. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows, then you discount that number back to today's value. This company has negative free cash flow, and it's getting worse each year. Net income is the profit and loss on the income statement. It's revenue minus expenses. Their net income is also negative and getting worse each year. Their revenue looks really good. It goes from 30 million up to 300 million, a 1,000% growth. This is the company's income statement, and all these numbers are in Canadian dollars. The numbers on my Excel spreadsheet are converted to US dollars since we're looking at the ticker that trades on a US stock exchange. In 2020, they had revenue of $400 million, but cost of revenue was more, $430 million. So they actually had a negative gross profit in 2020. In the prior years, they did have a positive gross profit, but they have such high operating expenses, it brings down their operating income to negative $1 billion in 2020. And also in 2020, they had negative $500 million of other income expense. They are a young and growing company, so will take time to become profitable. Here's a breakdown of their revenue. The bulk of their revenue was business-to-business recreational cannabis, $157 million. They also had $50 million of business-to-consumer recreational cannabis. They had $56 million of sales in medical cannabis in Canada and $68 million international. They also received over $100 million of other revenue. These are from their investments. So their operating cash flow was negative $772 million in 2020. It was negative $500 million in 2019. They have quite a bit of capital expenditures. Capital expenditures are investments in property, plant, and equipment. It was negative $721 million in 2020. So their free cash flow was negative $1.5 billion in just that 1 year. They do have $2 billion of cash on their balance sheet. Let's look at a capital structure. $700 million of debt, $3.7 billion of equity. They pay 7% interest on their debt. And they have 16% debt in the capital structure, which means they have 84% equity. Cost of equity is 18.22%. To get cost of equity, we use the capital asset pricing model. And part of the CAPM formula is the beta. That's how volatile the stock is relative to the market. They have a pretty high beta, 2.07. So the stock moves more than 2 times the market. And their WACC is 16.4%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $16.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8.6 billion. We divide that by 371 million shares, and we get a calculated stock price of $23.50. They're trading at $24.52, so they're trading at a 4% premium. It's a sell according to the model, but it's really close. This is the 4th cannabis company I looked at, and this is the closest I've been with my valuation. Simply Wall Street says the valuation is $41, so they're much higher than me. They're saying the stock is undervalued. It's a strong buy. When you value a company, you have to make a lot of assumptions, especially when a company has negative free cash flow. Apparently, Simply Wall Street's assumptions is the company is going to grow a lot faster than my assumptions. Let's see where the stock has been trading in the past few years. So it was pretty low 4 or 5 years ago, but the price really was driven up to over $50, and it came way back down to $25. So it looks like it could be a really good value, especially if it gets back to where it was 2 years ago. If you invested $10,000 when this company IPO'd in 2014, you'd have $71,000 today. That's over a 600% return on investment. In all of Canada, this company has 15.5% market share in recreational cannabis, and this company has over 50% market share in cannabis drinks. Let's look at the financial ratios. The average PE is 16.3, the median is 14.9. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have a negative PE. Average price of sales is 4.9, the median is 2.0. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 30.4, so they're doing much worse than the median and average. The average price to book is 4.6, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 2.5, so they're around the median. Equity is assets minus liabilities on the balance sheet. Average interest coverage ratio is 12.4, the median is 3.9. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. EBIT is earnings before interest and taxes. It's on the income statement called operating income. The average ROE is 12%, the median is 12%. ROE is net income over equity. They have negative net income, so they have negative ROE. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities. They're at 6.1, so they can easily cover their current liabilities. Usually when a company has a current ratio above 2, that means they're operating inefficiently. They don't need that much current assets on their balance sheet. Since this company is hemorrhaging so much cash, I think it's good to have a lot of cash in their balance sheet just to get through the year without taking on more debt. The best way to look at ratios is to compare them to similar companies. I've done videos on Aurora Cannabis, Becerra, Sundial, Supernus, Teva, and Tilray, all in the same industry as Canopy. And if Canopy has a number in green, they're better than the average. If they have a number in red, they're worse than the average. They have negative PE, so we can't look at that. Price of sales is much worse than the average. Price to book is about average. They have the highest current ratio of all the companies. Negative ROE, so we can ignore that. They have the lowest amount of debt of all the companies. And their market cap is really high compared to the average, much higher than the other cannabis companies. So to summarize, I have them trading at a 4% premium. Their ratios look decent, but their financials look terrible. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.